It's a pleasure being here today. I guess the way we've organized this is this is a bad news, good news presentation, and I'm giving you the bad news. You know, I'm focusing on the Western economies, primarily the Anglo-Saxon economies, and primarily America and Britain. And I've been here for a couple days, and I've done a lot of interviews with the press on TV and magazines, and they all ask the same questions. What about the recovery? And what about the Great Recession? And every time I have the same answer, which is I don't think there is a recovery, and I think we're going to have a resumption of the crisis of '07, and I think there's a good chance we're going to have another stock market crash. And I've been saying this so often that I'm afraid I'm going to wake up on Monday and find that there is a stock market crash, and they're going to blame me. But as I keep saying, there is no recovery, and there was no Great Recession. These are very, very different things. A recession is a pause in an otherwise healthy economy. A recession is like a case of the flu or a bad cold. But what we have here is something different. We have a situation in which the economy has died. The economy that we've known for the last 50 years is dead. You can't revive a corpse. It doesn't work, so you have to go on to something new. There's no chance of a recovery. We're not going to have a recovery. We're not having one now. And there was no Great Recession because it was not a recession at all. We are in a depression, or what I call a period, which might be called the Great Correction. You know, a depression is a time in which mistakes are corrected. That's why I refer to it as the Great Correction. It's a time of deleveraging, time when mistakes are corrected with debt is paid off. But we're correcting something now which is much bigger than any correction we've had in our lifetimes. This is a huge, huge thing which people don't understand at all. It's a correction of 50 years, more than 50 years, because it started right after World War II. The modern economy was born after World War II, and this has since been more or less the same economy with several recessions along the way. And this economy is an economy of credit expansion. It's credit expansion in several ways. In the growing economies, in the producing and exporting economies, it's expansion of the output capacity. But mostly, it's driven by expansion of the consumer capacity in the United States of America, and to a lesser extent, to Britain. That credit expansion has gone on since 1945, and it came to an end in 2007, just 3 years ago. And that's the primary economy that we've lived with, we've grown up with, that we know. That economy is dead. It's dead. Dead is the door now. It cannot be revived. It cannot recover. We're also correcting, I call this the Great Correction because there's several things being corrected. We're correcting a 39-year expansion of the dollar-based money system. And that's also a correction because we know that dollar-based systems do not usually last so long. And we've had a huge expansion of dollar-based assets in the world. More and more people have more and more dollars, and they think they're worth more and more money. And we're going to have a correction. We're going to find out what those things are really worth. We're also correcting a bull market in assets, in primarily stocks and bonds. It's gone on in the U.S. since 1982, and much of the rest of the world following pretty much the same pattern. There have been recessions during this great bull market. There have been bear markets in the bull market, but this is the first time we're having a genuine correction of this long wave of asset increases. And we're correcting economic theory. We've been living with an economic theory that is essentially wrong. This economic theory has dominated the economies of all the major countries all of our lifetimes. This is the theories that grew up in the Depression. The theories of John Maynard Keynes was probably the major character in this development. But there's also Thomas Phillips, who developed the Phillips curve, And then out of these things, the same way of looking at things, comes all of modern portfolio theory, ways in which the investment community, the way in which the financial industry created derivatives, came from the same body of thinking, which was fundamentally, deeply flawed. And so now we're looking at a correction of that way of thinking, a correction of that theory. And finally, I think we're also looking at a correction at the end of a 400-year expansion of the Anglo-Saxon Empire. Now, that expansion began in the beginning of the 17th century, began because Britain was was the leader in the Industrial Revolution. That put the Anglo-Saxon economies into a leading position, and that position has held up for 400 years. You know, where the peak was exactly, I can't tell you. Maybe it was in 1986 when the U.S. went into a deficit position on its trade balance. I don't know exactly, it's hard to say, but I think that the expansion of the English language, the expansion of American English, Anglo-Saxon financial institutions, cultural institutions, and military power. At the beginning it was an empire of conquest led by the British. Later on it was an empire, commercial empire, financial empire, backed up by the Pentagon. And that has extended for a long, long time. But I think we're looking at the end of it. You know, they say nature abhors a vacuum and detests a monopoly. Well, since 1989, the U.S. has been in a monopoly position on military force, has not had any challengers, no significant challengers anywhere. So we're coming to the end of that period. Whether it's the beginning of the end, the middle of the end, I don't know. We're not at the end of the end, I'm pretty sure of that. But we've got a long way to go, but all of these things are peaking out now, and we're looking at corrections.